My name is Todd Foster,
Now we
and I
have
just
to know
wanted to share
when
some
to
info with you. For the past few months, the mortgage rules seem to change every few weeks. As a mortgage consumer, lowest interest rate is often the first thing on your wish list. However, the interest rate pricing game is getting very complicated. In fact, let me lay it out in chart format to make it easier for you to understand. There are three mortgage words you need to be familiar with: insured, insurable, and the word uninsured. Insured simply means your mortgage will be insured with CMHC or similar insurance providers. The borrowers will have to pay the insurance fee, which is often added into the mortgage amount. Insurable are mortgages that will meet CMHC guidelines but are not necessarily insured. Uninsured, as the word implies, does not meet insurance guidelines. The mortgage rate pricing is based on which of these three categories your scenario goes into. Now let's take a look at purchases and or switches. When you switch your mortgage from one lender to another, without any increase of the mortgage amount, this is called a switch or transfer. In the case where you need more money, it will be a refinance, which we will talk about under non-insurable mortgages. Purchases or switches are when the borrower pays the CMHC fee. It offers you the lowest possible interest rate. As you can see, at the time of this video, interest rates are as low as 2% for a variable rate mortgage and as low as 2.54% for a 5-year fixed term mortgage. When you purchase with more than 20% down payment, CMHC insurance fee is no longer required. However, the interest rate will be higher than the insured mortgage. The higher the down payment, the better the discount. CMHC no longer insures purchases above $1 million. This will fall into the uninsurable mortgage and will be charged a higher interest rate. The rule, in this case, is the purchase price. If one buys a $2 million property and requires only a $300,000 mortgage, there would still be a premium to the interest rate. In fact, the majority of the lenders would not fund an uninsured mortgage at all. CMHC no longer insures refinances. If you need any kind of equity takeout, meaning increasing your mortgage amount, you will be paying a higher rate than the best available rates. There are also other factors that affect your interest rate. Your credit score is a very important one. Obviously, the better the score, the better the rate. In fact, if your score is low, you may not even get an approval. Other pricing factors, like having a 30-year versus 25-year amortization, an equity takeout, and the mortgage amount are just a few of the factors. At this point, you are most likely frustrated, confused, and feel this is not fair. Please, do not shoot the messenger. It is what it is. There are numerous groups lobbying the government as we speak. In the meantime, we have to do what we have to do for our own due diligence. I have learned that interest rate is a small part of mortgage planning. Most of us have enjoyed super low interest rates for the past few years, historic lows for that matter. Are you any richer because of that? Getting a mortgage is not an event, it is a process. A very carefully planned process in order to save thousands of dollars. I use a very simple 4-step process. 1. Your plan must give you peace of mind. 2. You must have manageable cash flow. 3. There must be a way to quickly pay off your mortgage. 4. Your mortgage can also be a tool to provide you with financial security and prosperity. Thank you for watching. If you have any questions or would like to review your current mortgage situation, please email me at foster.t@mortgagecenter.com.